Well, good afternoon, traders. Here we are, Monday, the 22nd of October, and here we are for our weekly live classroom. And a big thank you to all of you that have sent through emails of either stocks that you'd like to see covered, or indeed feedback from recent boot camps and your trading experience, and certainly a bit of a baptism of fire for many people that are just starting to dip a toe over the last month or so. And part of the reason for that, of course, is why we've been telling you to keep your powder dry. Here's a little look at the NASDAQ index. You can see here the Qs as it's known. And you can see that there's obviously a fairly meaty sell-off, a little bit of a bounce, which unfortunately, when people get emotionally charged with what they're doing, I think better get in. It's called fear of missing out before this recovers and pushes back up. And one of the key things that we don't like are those V-shaped recoveries where stocks push down and then push straight back up again. This has got a little bit of work to do to regain investor confidence, and I think that's probably what we're going to see over the coming weeks. October, historically, not necessarily the strongest month in the stock market. It typically is where we've seen some of the bigger corrections over time, and I think we've probably had that for the month now. So there's no urgency to get in. I know it's very frustrating sitting on your hands. There's this market that's significantly cheaper than what it was, but just looking at the chart there, you can see that this sort of 170 level is probably where the support level kicks in. In fact, let's just draw that on there now and run through this. So we'll just fire that on there. So we've got a point of reference on this chart at 170, and as some of you will know, you can just type 170 in there and that rounds it up to exactly where you want it. And you can see that there's a very, very clear level there. We tested it in the midst of the sell-off a few weeks ago. So what's going on at the moment? Well, a little bit of interest in the geopolitical sector. Obviously, the story that's come out of Turkey in regards to the Saudi Arabian embassy and the debacle of what's going on there, and Saudi Arabia's changing of position, if you will, on that is the sort of thing that unsettles markets a little bit, particularly in the commodity space. And if we look at oil, that will be the one. Also, talk of the US ending its non-proliferation and nuclear treaty with Russia, which has been in play for about 30 years. Another thing doesn't augur well in markets. But overall, that's the normal world we live in these days, tweet to tweet, where things really do move around. By and large, we've had a result season that's been okay thus far. Certainly the US banks came out with some good numbers, and so things are kind of moving along in the right direction. So let's get stuck into that now. And again, thanks for those of you that sent through some of the Lynn. I think you want to look at Comcast and S-Hand. You want to look at what we do to hedge positions. So we'll go through those and a few other things too. Now, one of the things I covered last week, not very well, I was a little sleep deprived last week with a little one, but very pleased to say she's sleeping through, which is great news, is changing the names on your watch list. So if you make the watch list window bigger, just go across over here on the settings, and I'm just going to call this today's webinar. Oops, learn to type webinar, and now I have my my watch list there called today's webinar, and I can keep that filed accordingly. Now that can actually become quite useful for you if you have multiple watch lists, and I'd probably suggest that you do that. I usually create these at the boot camps based on your suggestions of what you want to see covered and leave them on here so we can update them, but also you might want to have, for example, the stocks that you trade. So it might be US stocks in the tech sector. It might be other kinds of stocks. You might want to sort them in order to make sure that you're not wasting your time analyzing a stock like Netflix at $332. It may be a little bit pricey for you, yet there are plenty of stocks there that are at the cheaper end that you can trade, of course. So lots of ways of cutting it up. You can do it obviously alphabetically and so on and so forth. So let's get stuck into this right now. I did start to go through that last week, and I just couldn't put my hand on how to change the name of the watch list, but quite useful. And I think you'll find there is a capacity as to how many stocks that you can put on these as well. So you're probably good splitting it up into technology and maybe blue chip, large cap, whatever it might be, optionable stocks, Aussie stocks, so that you've got them in different lists just to keep it nice and clean. So I'll start off, if I may, and I'm just looking down because I've got a few notes here. Eshan, and thanks very much indeed for A, joining us at bootcamp and playing hard, and B, for the question that you've sent through. The thing that we were talking about as a short position in the markets, it's called SH, not CH. SH is an exchange-traded fund which, as you can see here, when the market falls, typically performs rather well, and you can see that this has enjoyed quite a run. Would it be something I'm looking to jump into now? Well, as I've already looked at with the NASDAQ, there's a little bit more downside, I think, in this market, but I think that the vast majority is already shaken out, so I don't know that there's too much more upside in this. I could be wrong, but I wouldn't be looking to buy into this today, for example. And on this, you'd be better off doing your analysis work on the index rather than on this particular instrument, because it is a derivative of the instrument, the index. So SH, just to help you, there is the code. Currently, no options on this, which is unusual because there are options that are tradable, and we'll have a little bit of Sexo to see if we can get those added to this. There are a few things that they're working on the product at the moment, so we can have a little bit more oomph on there for you. One of the questions that keeps coming up is in relation to IV, and we're just about to relaunch the machine, and that will handle all of your IV requirements and needs very, very clearly within there. Also, I shouldn't tell you this, but they will have Aussie stocks on here for doing covered calls, probably early to mid next year is the sort of timeline we're looking on that, because I know a lot of you want to do that, so we'll get it on there for you. Righto, let's dive in and look at what's working and what's not in the market. And when we get times of unsettled periods, the areas that are the real stellar performers tend to be the ones that bear a little bit of the pain. So Lulu's had a really, really strong run. We've probably run through it with you at boot camp. It's given a lot of that back, being in the high street, a little bit of shakiness in the market. People maybe spend a little bit less. You could argue, let's just go along and have a look at Tiffany, which is not dissimilar insofar as it's a high street retailer. You can see that again, a lot of the sheen has gone out of that stock over the last month or so. So we're Under Armour we can probably look at as well as a high street play. So and that's been a little bit more of a structural decline there. Interestingly enough, this is a stock that came up at the more recent boot camps last month, and that $18 level is actually holding quite well on this stock. So it does appear to be finding holding support there, which is really, really good news. Let's just drop this down, and you can see that we've either broken that downtrend line, if that's the line you're working with, or if we're going a little bit more softly there. There's a little bit of work to do, but it's certainly coming into a bit of a cone there at around $18. So keep watching that one. I think it is an interesting stock, and we were looking at this just a month or so ago, just prior to the market sell down back over here, and it hadn't quite hit the criteria that we wanted. And that's why we wait for confirmation. But you can see the high street has suffered a little bit. So where does the money flow in these circumstances? And what we look at are more defensive stocks. So Disney is one of those, and I've talked extensively about how much we like Disney as a business, given the fact that it's the content king. Its theme park merchandising business is very, very strong, and you can see that it's actually recovering and gone very, very nicely through this choppy period in markets. And ask yourself this, in times of uncertainty, investors, they want to be with stocks that they feel are well-rounded, and Disney certainly is one of them. Another one, and this will be good for you from your personal growth perspective, and please do note this down. One of the defensive areas that we see in the economy, and we're looking at this on the basis of the US right now, are what we call utilities. So this is a company called the Southern Company. SO is the code. It's a big utility company in the US, and utilities typically are a place of safety in times of market uncertainty. And I want you to just think about what the logic would be there, because a little bit of chaos in the stock market, a few of the sort of darlings in the portfolios, your high street retailers like Lulu or Tiffany probably wear it a little bit. Certainly stocks like Nara in the building space do. But that money has to flow somewhere. And the place that it tends to flow are the more defensive sectors. We've just talked about Disney as one example, and then utilities, companies that provide water or electricity, tend to be very, very defensive for the reason that, well, you're probably not going to turn your air conditioning off, or you have less baths because the economy is turned down a little bit. So the demand for their product is reasonably robust. So SO is actually a nice little stock to trade. We've traded this a number of times over the years. And it's a reasonably affordable stock. It's sort of $45 a share. Technically, they're just at a bit of a resistance level now, but if we were to spend some time, the sorts of things that should be screaming at you on the screen here would be number one. Where are we here? That's what I'm after, this tool here. $43 being our holding support, and if we just draw a downtrend through here, we could be fairly aggressive. Obviously that's quite steep, and you'll know that I like my lines to be sort of at least 30 degrees. That's probably still a little bit steep. We could probably take it out through there. But this downtrend has been broken. We've got a higher bottom, and this actually is a bit of a golden fingerprint setup. If we were to add some volume to this, you'd probably see that the volume was quite significant there too. Let's just bring that up. And as you can see, that volume popper right the way through there just reinforces actually a very nice golden fingerprint setup here. These candles here, a little bit wishy-washy. See what those crosshairs. These candles, in fact, we'll zoom in and have a closer look at this. This first high bottom, this candle here, if this was a really strong close, I think that would be a buy day. As it was a bit of a wishy-washy close there, so it didn't quite follow through, but really nice example of the golden fingerprint, so that system does work for you too. Looking at the US banks reported, and the numbers were quite strong. Wells Fargo, I do like, is a broad-based US bank that's more in the banking space as opposed to the investment banking space. And we talked about this, I think, last week. Around about that $52, $53 support level, which is where it's at right now, it is quite a pivotal support. Obviously, it's not a bad stock for covered calls either. You can see that there's a range here up to around about 57.50. So you've got about $3-4 worth of range there, which is about 8% plus some options premium. Not a bad space to be looking. I'll be waiting for a touch more confirmation just looking at this, because it does. I'm not going to say it looks sick, because it doesn't, but it's just holding on to that support level at the moment. And as I said right at the top of this broadcast, patience is so important. Don't be thinking you just got to jump in and you're going to miss out if you don't. Sometimes you just got to wait for things to shape up. You don't wait forever in terms of indecision, but you do wait for them. And as you can see here, actually, it's not a bad example. If we just go back across here with Wells Fargo, you can see that it went into this consolidation phase for about 3 months before it popped out. So just watch this one, have it on your watch list. It's a stock we've traded a lot, we quite like. Bank of America, slightly more spicy type business, even though it's a retail bank. Bank of America actually owned Merrill Lynch. They bought them in the GFC a few years ago. The Thundering Herd. Merrill Lynch, one of the oldest broking firms in the world, or certainly in the US. Again, this one is sort of holding down its support. I'm less inclined with Bank of America if I'm looking for a play on the US economy. I'd be more inclined to take Wells Fargo because it is a purer play. One area to stay well away from, Lennar. As you can see, that's just turning into a donkey's doodah at the moment. And again, this reinforces, and that's a technical term we coined down in Sydney the other week for this sort of chart. You can see this one is really broken down from that $50 level and has continued to drift. And this is the importance of stop losses. It's not a problem being wrong as long as you manage being wrong. And you will be wrong a lot as a trader. You're going to be in trades that don't work out in the way that you expect or like. And when that happens, you cut them early. So if we take... and I think, was it Eshan? It wasn't Eshan. Ganit, I beg your pardon if I've pronounced your name wrong, my friend, was talking about Pfizer, and they got in and stopped out fairly quickly into that just with the pullback in the market. And it's not a problem because that's the risk management working. We'll just bring Pfizer up to have a look. It got caught up like all stocks did. In the sell-off that we've seen, and there's no problem getting chopped out of it, stopped, because that's your risk management working. It's actually recovered again now, so your analysis was absolutely right, which gets a little bit frustrating, I guess, when your analysis is right and then you look at the trade and you're not actually in it because you got stopped. But that's what stop losses are there for, to help protect you from those catastrophic risks. And Lennar has just been drifting down. Good reason to stay out of it. Another one in that space has been Alibaba, which was a market darling for the last 2 to 3 years. And has just been really struggling a little bit. 150, it sort of is punched down through now, which I really don't like the look of. So I'd be very, very cautious and careful with that stock just for the moment. Now, in that tech space, by the way, Facebook came out with the impossible that active user growth in the US, or engagement, actually it stalled in the US, and that's quite a big thing, although Facebook's business is truly global, as we all know. And as a consequence, there's still growth coming in that business in many of the other areas. And I think what that possibly what we're seeing flow through is a little bit of a reaction, if you will, to the events earlier in the year that really plagued Facebook with, the Cambridge Analytica type stuff, which kind of besmirched the brand, if you will, a little bit. And and you've seen users back away a little bit, and obviously that does impact then on advertising revenues to an extent too. But I think long term, it doesn't have a competitor. It's the world's largest advertising agency. Without a competitor, it's in a very nice place. And so I wouldn't read too much into it. It's a nice little story on seeking alpha. So do take your time, go have a read of that. and it talks about the fact that whilst this slowdown in US subscribers is not ideal, it actually isn't the end of the world by a long way for Facebook, so just bear that in mind. We're on the subject of stocks in that space. Netflix, another favorite of ours. That's sort of holding well at around about that 330 level there. Again, it's a fairly expensive stock, so it may preclude many of you from being able to trade it. But on the platform, we actually have, we just bring up Netflix again here. I think we can do CFDs on that too. So with the CFD, instead of having to pony up $332, you're only going to have to put down $33 a share if you wanted to get a slice of that. Obviously, you are working with leverage, there are risks associated with that as well, but it may give you a softer way of getting some exposure to that. I'd be a little cautious with this stock just at the moment. A, because Disney's really on a roll and Disney is a primary competitor for this, and B, as you can see, the volatility, if you look at the length of these candles just over the last number of trading sessions, not just through the sell down, but also with the recovery that's started to push back up on the other side of the equation here with this really quite rapid move up to the 375 resistance level and then back down again. Look how long these candles are. By the way, for those of you that have been to boot camp, particularly in maybe the last 4 or 5 boot camps, if we look at these candles, this is kind of like inner ear technology in terms of the big moves. Long dominant candle on Friday there, as you saw over here as well, and then these really spindly type candles here with long wicks and shadows. Not the sort of thing you want to see. It just shows a little bit more volatility in this stock. The IV will be creeping up, so the options premium will be quite nice, but you don't get the rainbow without the storm. There's obviously risk associated with that. Okay, so and seeing as we're talking about volatility, let's just talk about the basket case right now, which is this one, being Tesla, and and we've covered this to death at boot camps. It's just very difficult, even with strong production figures, just to see where this business is going right now. And I think when you're in doubt, just leave things well alone, and that's very much my sentiment toward that stock at the moment. Getting a bit closer to home, we'll start looking defensively, and we'll take a look at Woolies, and you can see that Woolies actually weathered the storm reasonably well over the last few weeks with the market, and that's again because Woolworths as a grocer is quite a defensive, not that spicy a stock, and it stood itself in very good stead through this movement in markets. It's probably been one of the lower volatility plays in markets, certainly in Australia over the last little while. And I don't mind the look of Woolies there. It looks like it's trying to shape up. It's coming off this good support level through here, which I'll just put on the chart for you right now, just around about that 27.50 level, as you can see there, with 28 being a bit of a resistance level. So I'd want to see it push up through 28 on good volume, and I think what we would then see, in fact, let's just analyze this together. Hope you find this useful, guys. It is recorded. We just seem to be running into some difficulties with these broadcasts, trying to do them live in terms of the imagery coming through sufficiently fast from your end on the internet, so that you're kind of keeping up with what I'm saying from my end, if that kind of makes sense. So we'll continue to do these on a recorded basis for the moment until we get that really ironed out. And it's a little annoying because I do like doing those live. I do like doing them live because it keeps us on our toes, and also I think from your perspective, that ability to pose questions is probably quite handy as well. All right, so let's just zoom in and have a look at this in a bit more detail. So 27, 50, 28 are our levels there. We've also got this downtrend, which initially was going through here, but we'll fan it out a little bit, and we can see that, in fact, if we just fan that out through there, that's actually quite an interesting pivot point. Let's just get rid of that volume there for the moment. You can see that we're now above support. We've broken this downtrend, and we could have the makings of another higher bottom up here. And I think a break of 28, maybe even through this neckline here of 28.30. It's only about 40 cents away from where the stock is trading, and okay, that's a few percent. But nonetheless, I think it will be a nice entry, and I don't mind the look of that, and I can see this stock potentially in more difficult times enjoying quite a nice run. Elsewhere in the Aussie market, the banking sector, and I haven't published this on Facebook yet, but I recorded something a couple of weeks ago just before the baby came along, actually, on the banking sector, and I just have grave concerns for the Aussie banks. I really do, and if we see a change in government, I think you can almost... well, no, let's not go there. I think, I do have some grave concerns on the Australian banking sector right now with their exposure to property. Elsewhere in the resources space, let's look at the big fella. Let's just bring up BHP. Haven't looked at this chart for a little while. And BHP is going about its business. Obviously, it's caught up like most stocks in the sell down, but appears to be balancing out at around about the $33 level, and looks to be sort of trying to shape up. If we can add some volume in here, it looks like it's trying to shape up with a view to garnering some support around about that $33 level and pushing higher, and I don't mind the look of that. Now, obviously quite an expensive stock, a second tier stock in this space, and Greg, I don't know if you're watching today, but we discussed this a couple of weeks ago. Mineral, MIN is the code. It's not an options trade, it's a pure stock trade here, or you could do the CFD on it too if you wanted some leverage in there. Let's just fire these lines through here. We can see we've broken that downtrend. We're crabbing along. $16 we'd want to see broken in order to get into it, but it's actually got pretty good holding support around about that 15 level. So if we're looking to get into this, it'll be a break of 16. Do quite like the look of that. And then in the commodity space, I mentioned earlier in terms of possible global angst and affecting crude oil prices and the like. If we look in the oil sector just for a moment, let's just fire on ExxonMobil on here and take a look at its chart. This is a stock that's been pushing higher, albeit on higher oil prices once again. Let's just overlay, nice useful tool this, CLC1, which is the crude oil futures contract. There we go, light sweet crude. Let's just overlay that, and you can see there's a very, very close correlation, as you would expect. One's an oil company and one's the commodity price of what it sells. So of course they're going to be correlated rather like day follows night. But very, very interesting on this crude. There's a lot of pressure on that at the moment. With geopolitical tensions with Russia, which is a major exporter of hydrocarbon, obviously with Saudi Arabia, which is a massive exporter of that, and what Iran's future is, and all of this. All very, very challenging, and I think this is one just to keep a little bit of an eye on. If we start to see oil prices creep up again, then certainly Exxon has got some good catch-up value. There's a good $7 or $8 in that. Now, of course, it's an $80 stock, so let's make this a little more affordable right now and bring this back to Oil Search instead. Now, I've left that crude oil overlay on here, and you can see that Oil Search also behaves rather well and follows on from crude oil. So, a lot cheaper at $8.50 than $88, as we've seen with ExxonMobil. So keep this one in your kit bag. If you do see oil prices moving up, then getting a play here on a stock like Oil Search, certainly well worth doing. I'll get rid of that blue line on there, all the blue candles, which is the crude oil. I just want to leave that on there to show you just how closely correlated they are. Obviously, with rising energy prices, stocks that use a lot of energy, Qantas being the immediate one that springs to mind, this is going to be having a real tough time with commodity prices rising, and you can see that that's been reflected in its sell down through there. Maybe the executives aren't quite as smart as they've made themselves out to be, turning the business around. They have been helped by that weaker underlying oil price over the last few years. So plenty to cover in there. The underlying message I do want to share with you on this is that to make sure that you're not in a hurry to dive back into this market. Sometimes the hardest thing you can do is sit on your hands, especially if you're at this new point where you've built your momentum up, you've opened your account, you've been to boot camp, and you're ready to go. And you're all dressed, but you don't really have anywhere to go. There's no trade coming through, and it's important sometimes to sit on your hands. Don't lose your momentum. Understand that it's very much a conscious decision to not be having a swing and a miss, or worse still, a swing and getting caught in these choppier times. There'll be plenty of trades that come up. It's a question of making sure that the right style of trades and at the right time. So take that on board. Be patient. Keep tuning into this, and of course, keep emailing us through stocks that you'd like to see covered, so that we can make sure over time that we continue to cover what it is you like to see. Always a pleasure chatting with you guys. Good to hang out today, albeit via this recorded broadcast. Again, final nominations I think for Trade of the Month are today, so if you've trades you want to tell us about, email them through. There's a few that have come through that are quite interesting, so put your hat in the ring. Email us at support@australianinvestmenteducation.com.au, your Trade of the Month nomination of what you've traded and why you're happy with it, and we'll see how we go. Meantime, great to be touching base, and look forward to speaking with you, hopefully with some trade wrecks over the coming week or so as this market starts to stabilize. Enjoy the rest of your day. Bye for now. Cheers.